Hello, hello, hello. Come on in, come on in, come on. Come on in, come on in, come on in. Happy Tax Tip Tuesday. I give you a minute to join me. Hello, hello, hello. Like my shirt says, one day at a time, one step at a time, but never stop stepping. That's my motto. Trademarking it. Come on in, come on in, come on in. We'll be at my whiteboard, but I got to figure out the lighting over there. So until then, you get the beauty behind me. So I'm going to go ahead and get started. When you come on in, say hello, hello, hello. I am so happy to have you. So a little about me. I am Tracy L. Tate. I am the CEO of TLJ Professional Services, where we are about all things financial. And I bring to you over 35 years experience and education in bookkeeping and accounting and taxes. I have a master's in business, a master's in accounting, as well as a master's in public administration. And today we're going to talk about the tax credits. So the IRS is officially open. Woohoo! As of yesterday, the 24th. However, California State was not accepting returns yet. So they're not in sync. Be mindful of that. Normally, when you issue or submit e-file, you e-file for both federal and state. So don't be in too much of a rush to jump on the federal refund bandwagon because you might leave state money on the table. Oftentimes, when you split them, us as tax preparers, we look at it like, okay, that client is one and done, right? You split them with me, that's a problem. So your return will not be filed until the states are open too. But they'll be sitting there ready and waiting. Say hello when you come in, come in, come in. So today I want to talk about the tax credits, and I want to correct a live that I did before. I had y'all all hyped up. I was hyped up for you. Hey, Miss Tiffany, and I misspoke. So my apologies. That $8,000, you is not getting that in the tax credit. Hey, Nisi, love you, baby. You will not be getting that as a refundable tax credit. My apologies. That would have been lovely, but they love y'all. They don't love you that much. I know they're trying to stimulate the economy, but they ain't stimulating it that much. So my apologies. So let me clarify what that 8,000 was for. So normally with the child dependent care credit, okay, that's what changed. The child and dependent care credit. So you have up to $8,000 in expenses and up to for one child and up to 16,000 in expenses for two or more children. However, you get to claim half of that. So this is a refundable credit. So it's still good money. Don't get it twisted. But it ain't the 8,000. Okay, you get half of the 8,000 for the expense credit, and it is refundable. So it's 4,000. It's not 8. It's only 8,000 if you have two or more children. So I misspoke, but I didn't misspeak. Okay, so that part is refundable. Okay, now in order to claim the child tax credit, your child have to be claimed on your return, and they need to be 13 or under. And if you're married but filing separately, you cannot claim the credit. So I've talked about that before. People think that they're getting over when they file married filing or file a single or head of household instead of married filing jointly. However, you file married filing separately, you get no love, no credits, no nothing. Okay. Married filing jointly at least increases your phase out periods, your income, right? Where like a single, you only get 75,000 as a phase out, or where it normally starts. It won't start to 150 if you're married filing jointly. So keep that in mind. So again, The child and dependent care credit is where that $8,000 is. And yes, you can still get $8,000 refundable credit if you have 2 or more children. Otherwise, it's $4,000, not 8. Okay. So my correction and my apologies. Now, another credit that you could get is the education credit. So this is a credit that's been out for a minute, and there's 2 main types. It's the, what's the name of that? It's a lifetime credit, and I don't forgot it. Anyway, I forgot the name of the credit. I'm having a brain fog. In any case, you do get to take credits if you're in school. So if you're in your undergrad or taking classes, you have to be at least half-time student. Hello. Thank you. Well, no, not the Hope credit. It start with an A. It's not all-time credit. It's a AOC is what it stands for. Thank you, Mark. Hey, Niche. But if you're not in your master's program, you are in a bachelor's or below, you could do the American. It's called the American Opportunity Credit. Brain came back. So the AOC, American Opportunity Credit, you can claim up to $2,500 if you're in your undergrad or lower. If you're in your master's, you can't claim that one, but you can claim the lifetime credit. So you could claim the lifetime credit. That's only $2,000. However, it could be in any of the years. So with the American Opportunity Credit, it's only up to the first 4 years of school, of college. Let me rephrase that, of college. That's normally bachelor's. It's not master's. So if you're going for master's, you would have to take the lifetime credit and get $2,000 instead of $2,500. So be mindful of that. And the American Opportunity Credit, you can only take it or claim it 3 times. The lifetime credit means just that. It's a lifetime. Exactly, Mark. American Opportunity Credit. Thank you. So you are in school. Don't forget to take your credits for being in school. It's called the education credit. Okay. This came into play with Obama. So he was very pro-education, and he was trying to encourage people to go back to school and benefit them from that. And excuse my lip. You probably see it's kind of weird looking. It is. I'm like, woke up with a fat lip. Don't know why. I don't know if it's allergies or what. More than likely allergies. So forgive me for my one-sided lip. And you can laugh if you want to, because I've been laughing at it all day long. Okay, so we went over the child tax credit or child and dependent care credit, as well as the education credit. There's other credits. Now, the educational credit is not refundable, meaning that it can reduce your taxable income, but you will not get it as part of your refund. The child and dependent care credit is refundable. So that's $4,000 added to your refund. That's $8,000 added to your refund. Okay. So be mindful of that. Now, the child tax credit, where I initially said the $8,000 was, is not in the child tax credit. Okay. The child tax credit, you have to qualify. So there's several things. Have to be a child, grandchild, niece, nephew, stepchild, the like, under 17 at the end of the year. So if they turn 17 by December 31st, they no longer qualify. They have to be under. Let's say that their birthday is on New Year's. They qualify because that starts a whole new year. So as of December 31st of any year, child under 17, right, because they don't turn 17 to January 1st or later in that year, qualifies you for the child tax credit. You provide more than half of their support, meaning that they do not support themselves fully. They live in your house. They depend on you to feed them. Might not have to clothe them, but if you provide more than 50% of their support, which if they're under 17, I would hope you are as a parent, right? You get to claim the child tax credit. They have to live with you for more than half a year. So IRS use terms like up to, more than. You have to be mindful of that when you're trying to calculate your own stuff, because up to means that it's at that ceiling and below, right? If it says 17 and under, it includes 17. Okay. If it say under 17, it's 16 and under, right? So that was kind of the way that the age thing went. But this is also with half a year. So half a year is 365 days in a year. Half of that is 365. 150 is 375. So 176. Okay, you need to have had your child at least 176 days. So that's 1 day more than half, okay, or the larger half of half. They need to be with you more than half the year. There are exceptions, like if you have shared custody in a divorce decree, or an arrangement that way. And of course, if you have arrangement outside of court, they don't have to be the ones to say what, but only one of you can claim unless you're doing the benefit of it's a divorce decree. They have to be a dependent on your tax return, period. Meaning that they don't file their own return and claim their dependency. So don't get confused with a child that's working for the summer and they earn some money. They are not taking care of themselves more than half support, number one. They do get to still file a tax return. They can't claim their own dependency, meaning that they pretty much get the money that they had taken out of their checks for federal or state income tax. They'll get that back. That's what that means, okay? They can file a tax return. They just don't get credit for filing for themselves. You still get to claim them on your return as their parent and them being your dependent, okay? Does not file a joint tax return. So they can be married. Some states, legal age of marriage is 16. So they could be married, but as long as their spouse does not claim them on their tax return, then you get to claim them on your tax return. So it doesn't matter that they're married. What matters is the fact that you're providing more than their support, more than half of their support, and they are not claimed on a married filing jointly return, okay? And have to be a U.S. citizen, national, or resident alien, okay? So those exceptions is also, unfortunately, there's been a lot of children kidnapped. You still get to claim the child tax credit until the child is considered deceased. And as long as you keep that case active and open, they are not deceased, period, unless they find a body or something like that. So you get to claim that. Oh, you tag somebody. I'm like, what is Koya? Come on in, Miss Koya. Okay, so that's the child tax credit. Now, with the child tax credit, there used to be, or would normally be, additional child tax credit. And that was because the child tax credit, you can only take a portion based on your income, right? But now, under this new plan, there are several things that they made changes to. So they're expanding the eligibility to 17. So remember when I read earlier that it was under 17 at the end of the year. Okay, so they're actually including 17-year-olds. So it's now, as long as they were 17 as of December 31st, you get to claim them on 2021. These are not permanent changes. They are temporary changes for the 2021 tax season, okay? So you get to include your 17-year-old now. You didn't get to do that before. Making the credit fully refundable. So what that means is that the additional child tax credit used to be because you were only able to claim a portion of the child tax credit, you could get the additional child tax credit to give yourself more credit on top of the phase out for child tax credit. However, since the child tax credit for 2021 is fully refundable, then you don't have to worry about the additional child tax credit. Now, the rates increased from $2,000 to $3,600. So I corrected that on the live like a week or so ago. So where you used to get $2,000 per child is $3,600 per child if your child is between the ages of 0 to 5 years old. Okay. 6 through 17 years old, the child tax credit is $3,000. Where it used to be, what it used to be? 2,000. So it used to be 2,000 across the board up to age 16. Now it is, if you have an infant, basically 0 to 5, infant toddler, then you actually get to claim 3,600 per child. And if they are 6 through 17, then you get 3,000 instead of 36. Still a win-win. Okay. They actually increased the phase out limits as well. So they are trying to get the economy going and flowing and putting money back in people's households, right? In the households, to get the economy going and to help people stay afloat, because it is crazy out here. There's so many jobs out here. Don't nobody want to work. So if you are looking for a job, the choice is yours. Like, you could literally claim your own terms, like put together your own terms, your hours, where, who, what, when, why, where. You get to pretty much have your choice in employment this day and age, because nobody want to work because of the pandemic, because of being vaccinated and all that stuff. So this is opportunity, because one thing I will tell you, especially my next topic, which is the earned income credit. If you don't earn income, you don't get to take that credit. Okay. It is fully refundable, as well as the child and dependent care credit. However, you have to have earned income, meaning not unemployment. You don't get the earned income credit if you did not work, period. Okay. So that's opportunity to get more credit on your tax return if you work. Now, us as tax preparers, us being me and my team as tax preparers, we have to sign off on the due diligence. That due diligence says that I'm attesting to knowing that this child can be claimed by this person. We are fined $500 per incident if we don't do that due diligence to make sure that the child that you're claiming can actually be claimed by you. Right? It could be in the case of divorce. Maybe y'all supposed to alternate. Unless you got permission from that person, you could get in trouble for that. And so can I, as a tax preparer, for not doing my due diligence to make sure that you had the authority to actually claim that child. There's 3 tests for the earned income credit, the relationship. So it's kind of the same as child tax credit or the child dependent care credit. Age is under 19 or 24 if they're in school. And then residency more than half the year. So remember, I did the math earlier. It's 176 that they need to be in your resident. And in your resident does include if they're away off on college on a dorm, living away that way for school. So just know that. The only other credit is the premium tax credit. Now, if you got your health insurance through the market, for example, if they paid any portion of your health insurance, then you should get a form, a 1095A, which says their portion of the health insurance that they paid or that you paid. Now, federal removed the requirement for health insurance. However, states may not have. So California, they reinstated theirs this tax season, right, to say you have to have had health insurance, otherwise you're penalized. Okay, so be mindful of your state and where you're at. Health insurance is still a requirement, although it may not be penalized from a federal standpoint. It still can be penalized from a state. For the child tax credit, let me see. The phase out limits actually changed. So let me tell you the dollar amount. There is a phase out limit, but they increased it. So higher phase out limits, it was new phase out limits with a bonus. So single is 75,000. You make 75,000 or more, it start phasing out. Head of household, which if you have a child, you should be at least head of household. You should not be single. I'm not even sure why they have that in there. 112,500. Okay. 150 for the married filing jointly. So that's what I was talking about before, with the people thinking that they have it better to do the head of household and not claim married filing jointly when they're married. No, you get higher phase outs when you're married. Okay, you get more deductions as a married couple. So even the instead of the standard deduction, where it is, what is it, 1,800 now? 1,800 for a single? It's double that for married filing jointly. So you pay less taxes as married filing jointly. So to answer your question, Nisi, yes, there is a phase out, but it is higher income over $100,000. So, in the Bay Area, they're saying $100,000 is low income. So think about that, right? So head of household, which if you have a child, you are at least head of household, is 112,500 is where the phase out starts. And then the phase out percentage is 5%, at a rate of 5% of the credit amount. So it'll start going down at 5%, 5%, 5%. Okay. So finalizing the premium tax credit. So you have to include, you're welcome. You have to include on your tax return if the government helped you with your health insurance. Okay, it's called the premium tax credit. If you don't, you will be penalized. So just note that. And just because they helped you does not mean that you owe anything back, but you don't know unless you include the information in. So, and the only way you owe back is if you didn't report. Let's say that when you started with the assistance with health insurance, your income had decreased. So they're basing their support or their contribution to your health insurance premiums based on that dollar amount. You get a higher paying job and you don't report it, so they don't adjust their support. Then at the end of the year, when it all totals, that's how they're going to determine, like, well, wait a minute, we provided too much support, and they'll penalize you for it, basically for not reporting the change, okay? Because that's what it is. You need to report the change. So recap, as I always do, I am Tracy L. Tate. I am the CEO of TLJ Professional Services, where we are about all things financial. And today is Happy Tax Tip Tuesday, where we're talking about the credit. So I mentioned before, I did a live where I talked about an $8,000 credit. I thought it was a child tax credit. I wish it was a child tax credit. However, it is a refundable credit now, but it's with the child and dependent care credit. So if you have child care, because child care is about the amount of rent these days per month. If you have child care expenses, you get to claim $8,000 of the expenses for one child, $16,000 for two or more children, but you get to claim 50% of that. It used to be 35, it's 50%. So you actually get to claim up to $4,000 for one child or $8,000 for two or more children. Okay, so that's where that $8,000 came from. I just knew I had read it when I was doing my continuing education to keep my PTIN certification with the IRS. So the child and dependent care credit, you are allowed to get a refund or increase your refund by $4,000 if you have one child or $8,000 if you have two or more children. If you had expenses up to $8,000 for one child or $16,000. So it's not like you automatically get $4,000 because you had child care expenses. No, it's up to, right? So if you spent $6,000, you could claim up to half. That's $3,000. Right? So it's based on the amount that you spend for expenses, and then you can take half of whatever that amount is for one child or two or more children. Okay. To claim that credit, the child have to be under 13 because they figure a child could watch themselves over 13. Okay. So you cannot claim it for a child that is over 13. Now, things that people get confused about is whether or not, like, if you pay for a membership for your child to go to for after school, that is considered like child care. Okay, even up to 13. So the Boys and Girls Club, if you pay the membership, it probably won't add up to $8,000, but it is a deductible child care expense because you're working and they're going there as like an after school program or something like that. So keep that in mind. It does include programs like that, after school program, where you're paying a fee. Okay. But it's whatever you pay out of pocket, you could claim up to half and get that money back. And that's, you get half your money back for anything you paid to care for your child. Okay. Education credit, you could get the American Opportunity Credit up to $2,500 if you're in school, college, for your up to undergrad, so up to 4 years. For your bachelor's degree, that's considered undergrad. Otherwise, you would claim the lifetime credit, which is $2,000 if you're going for your master's or more. The retirement savings credit is called the Savers Credit, right? You get a credit for that, $2,000. I think I skipped that in my first section, but you can get $2,000 as a credit for contributing to a retirement plan. So whether it's a 401k, or IRA, right, and it could be in your through your employer or self-employed, you just have to be contributing to a savings plan in order to get that credit. Okay, that is another credit that will phase out based on income and all that good stuff. Most credits do. For 2021 is where they kind of limited or took away the thresholds on some of these credits, or changed the phase out on some of these credits so that more people could qualify for the credits. Okay. Child tax credit. The child tax credit, I corrected last week. It used to be $2,000 per child. Now, if your child is 0 through 5, you get $3,600 per child. If they are 6 through 17, you get $3,000. And they did move the age limit from under 17, so 16 and under. So now is under 18, so 17 and under is what they're making it, that you get to claim the credit. Because the credit is now 100% refundable, there's no additional child tax credit to kind of make up for that phase out like they used to do. So you get to claim 100% of that, and it is refundable. The premium tax credit is the health insurance. You should get a form. Do not forget about your form, because it is vital to the tax preparation. If you got help or assistance from the government, it's called the premium tax credit. Okay, that's help with your insurance. The earned income credit is fully refundable. There are phase outs, and it's based on how much you make. So with the earned income credit, you have to have earned income. You cannot have been on unemployment or government assistance or any of that to get the earned income credit. And there's a sweet spot of money that you'll get more if you're in that range than if you're lower or under, right? So you wonder why some people be getting $9,000, $10,000 refunds and stuff because they have children or earned income. That's why. It's because they fall right in that sweet spot. And it's normally between, I think it's 10 and 20,000 that gives you the most refund versus under 10 or over 20, because you start phasing out and you don't qualify for the credit in that case. So get with a tax preparer to take advantage of some of these credits. Yes, TurboTax could get you, they'll ask you questions, but one thing that I know about all of these softwares, these do-it-yourself softwares, how you answer is going to be the direction they send you, right or wrong, because they don't know if what you're saying or responding is right or wrong. So it's up to you to know exactly what the question means and answer it accordingly and appropriately. Otherwise, you're doing yourself a disservice, because you will not get all of the tax benefits and credits that you're entitled to. It really doesn't cost us that much to pay somebody, a professional that actually is accountable for your tax return, to make sure that you're getting the best benefits out of your tax season. Okay. So again, the IRS is open. Okay. They opened yesterday. However, the state of California in particular is not accepting returns yet. So to submit a federal, you still got to wait and do state. And that can be confusing to tax preparers like myself, because when I'm done with a client, it's one and done. They filed and they're done. Hello, Miss Cristal. You're going to have to catch a replay, love. So just get with a tax preparer, because it'll save you more than it could cost you in some of these credits. Okay, that's number one. IRS is open, state is not. So be mindful of that. Make sure, and don't be too hasty trying to hurry up and get a refund. Okay, remember, people that did that with the stimulus. And by the way, if you did not get that $1,400 stimulus when Biden first got in office, you can claim that on the tax return, like last year. If you hadn't got those first two stimulus, if you didn't get them, you could claim them as part of your refund. They did it again for the 2021 tax year if you did not get that third stimulus. Okay, so I don't want to go by dates. It's just a matter of, did you get the 1,200, the 600, the 1,400? The 1,400 is per person, by the way. The 600 was per person, but the 1,200 was for adults, and 500 or 600 per kid or something like that. But in any case, you should have got 3 stimuluses at this point. If you did not get that third one, you can include it as a refund on your tax return. What else do I want to tell you? Tax deadline is April 18th. Get your paperwork ready. That's what I was talking about. Don't be in a rush to submit your paperwork, because certain providers, like school, like banks, as far as interest statements, some mortgage statements, and even your employer W-2s, everybody in 1099s, if you're self-employed, they have until January 31st. That rule never changed. So the IRS is open, yes, but that does not mean that you got all of your tax documents, okay? So haste can cost you, because once the IRS do an adjustment, they just adjust, okay? Then now you got to go back to them and get their wheelhouse of madness to try to get the rest of your money, because you didn't wait, simply because you didn't wait, right? So if you forget any tax document and they adjust the way that they want to adjust. And now to get the balance of your refund, you're going to jump through some hoops up and down, okay? So don't be in a rush, okay? They ain't running out of money. That's one thing that is not going to happen. You're not going to run out of money. And these laws can only get better. They ain't going to get worse. So that happened last year, that people jumped with the unemployment and just went ahead and filed their return, not knowing that Biden was going to come in office and say, wait a minute, we're going to make 10,000 of that money of unemployment not taxable, right? My son is always one that jumps as soon as it's over. I already have his for this year, right? Before IRS even open, I ain't filing it yet. But because he didn't wait last year, he had to wait for the IRS to catch up to give him the additional refund he was entitled to, because the 10,000 was no longer taxable income, right? So just be mindful of that. Yes, the IRS is open, but you don't have to be the first to file. I mean, trust me, that money is not going to run out, and you will be given everything that you're entitled to. And work with a professional, and nothing. Just because I know how to fix my car, or I think I know how to fix my car, don't mean that it's going to run the way it would if I take it to a professional. Perfect example. Okay. So this has been Tax Tip Tuesday with me, Tracy L. Tate. We talked about tax credit. Please like, share, comment, and forward. Please share the information. Follow our page. You'll be known. You'll be told when I go live, and you'll get the replay. So type #replay when you replay this video. Definitely comment, like, and share. Share the wealth, share the knowledge. But this has been a blessed Tax Tip Tuesday, and my motto: take it one day at a time, one step at a time, but never stop stepping. Be blessed.